Hello, fellow Rebel Capitalists. Hope you're well. Wanted to go into some breaking news. The yield curve has inverted. We've been talking about this a lot lately on the channel, talking about the 2s and the 10s. Now, that is getting close. It's about 10 basis points right now, but the 5-year and the 30-year has actually inverted, and it hasn't done this since 2006. This is a very ominous sign for the United States economy. So let's get right into the article from CNBC and check this out. 5-year and 30-year Treasury yield invert for the first time since 2006, fueling recession fears. And this is today, the 28th. I think it inverted yesterday or the day prior, or maybe it was this morning. The yield curve on the 5-year Treasury note rose to 2.56, while the 30-year fell to 2.55. Just think about that for a moment. That you're lending the government money for an additional 25 years and charging less interest. As though there's less risk, less inflation risk. I mean, that is, when you hear the yield curve inverts and you're just like, whatever, who cares? But when you think about it in terms of actually lending money to the government at a lower interest rate for 30 years than 5 years, it's really mind-blowing that we could get to this point. And it shows you how really distorted and how fundamentally unsound the economy is when this can happen to basically the price of money. So they go on to say that this happened to the bond market in 2006, just a couple years before the global financial crisis. And a lot of people say, oh, George, well, this is nonsense. There's not going to be a recession, not a recession, even if the 2s and the 10s or the 1s and the 10s invert. But they forget that when they invert, we don't usually have a recession the next day. That's not how this works. It's usually a year, maybe 2 years later, once the long end starts to go up again, that's when you get the recession. And we're going to go over the predictive abilities of the inversion here in just a moment. So here is a list of the, kind of the main maturities and where they stand. I don't know if this is real time or when the article or the post was done, maybe this morning, but roughly speaking here, the 3-month is at 54 basis points, the 1 year about 1.6. That's the doozy. If you get the 1 year and the 10-year to invert, but the 2-year and the 10-year has the same predictive ability. But here we're looking at the 5-year and the 30-year, which again, 5-year at 2.56 and the 30-year at 2.55. And really, what's interesting is the 30-year at 2.55. Or the 10-year, at 2.46. You've gone up significantly on the 10-year from where it was maybe 2 or 3 weeks ago at around 2%, but yet mortgage rates, I think, have gone up a lot faster. And this is a result of, I think, future inflation expectations, but then also, I think the Fed not buying any more mortgage-backed securities, backstopping the market there. And you can think what would happen to mortgage rates in the real economy if the Fed not only takes QE down to 0 with tapering, but also starts quantitative tightening, where instead of buying those mortgage-backed securities, they're actually selling them back into the market or letting them mature. They're not buying anymore. They're not rolling over that debt. So going back to the article, with the Fed set to hike into restrictive territory, the curve will invert, said Seth Carpenter, chief global economist at Morgan Stanley. I wish he would kind of clarify which maturities he was talking about there. As has always been the case in the past, markets will debate whether an inversion, I'm not sure, presage, I'm not sure how to pronounce that, but basically the inversion predicts a recession. A policy mistake that causes a recession is clearly possible, but our baseline is that an inversion without a recession is more likely. I don't see how you could have this view. This view bewilders me. Now, it is true that every single time you get one of these inversions, and my good friend Lynn Alden pointed this out the other day, that the market always debates. They always say, well, this time it's different because yada, yada, yada. And now what they're saying is, oh, well, if the curve inverts this time, it's different because the Fed has been so active in buying bonds. Therefore, they've distorted the Treasury market. Therefore, you can't take, you got to take the yield curve with a grain of salt. And I don't think that's true. I think that, like this gentleman says, there's always been an argument, but the yield curve always has won. And that's why I'm very surprised his base case is an inversion is likely without a recession. I mean, let me show you what I'm referring to here momentarily. Let's go to the ones and the tens and the ones, although the twos and the tens would be equally predictive as far as its accuracy. But this goes back to 1953. And this shaded area, let me actually see if I can zoom in on this chart. There we go. That's a little easier for you guys to see, hopefully. The shaded areas are recessions. And when the blue line, and the blue line is the delta between the ones and the tens. So when the blue line goes below zero, that means the yield curve inverts. So let's just start here with 1957 because that's what we can see. We got an inversion there. Boom, we got a recession. Inversion in call it 60. Boom, recession. In fact, every single time you get a recession, you have a inversion that precedes it. With the exception right here, it looks like in 1966. Now, what would be interesting is to look at the twos and the tens because I don't know if the twos and tens, I'm trying to think here, inverted then. That's interesting. But you kind of got it a couple years later. Yeah, I guess that's too far out. I don't know if the twos and tens inverted right there. I'll have to look that up. That's fascinating. But we get it at the beginning of the 1970s, obviously, middle of the 70s, the 80s, the early 80s, you guys know what happened there. We got it prior to the recession in the early 90s. We got it prior to the dot-com bust. We got it prior to the GFC. And we got it prior to the cerveza sickness recession. So you might be able to say, let's just assume that the twos and the tens did invert right here in 66. You could say that, yeah, well, we didn't have a recession there. All right, well, we're looking at, and I'm just going to omit this one because I don't have the data going back before 53. But let's just look at 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So you've got 10 of these recessions. And the inversion of the yield curve preceded every single one of them. But 9 are out of, or I guess it would be the curve inverted 11 times. And 10 of those times you had a recession. So what is the probability if the curve inverts that you get a recession? It's not 100%, but my goodness gracious, it's got to be a high enough probability for that to at least be your base case, which, going back to this article from CNBC, really surprises me why this Seth Carpenter gentleman would say that he's going to take the odds of the 5% or 10% of the time when the curve inverted and we didn't get the recession. He's going to take those odds opposed to the 90%. That doesn't. I would take the opposite of, of that bet. When something's happened 90% of the time, I think that's a pretty darn good indicator. So let's see if they can add any insight as to why he might be thinking this. They're saying that labor market data is one economic indicator used by the Fed to help guide its direction. So investors will keep an eye. Okay, yeah, got it. February job openings labor turnover survey is slated for release on Tuesday. This is following the release of March ADP. Okay, but another thing I'd like to add to the mix before we conclude the video is the most recent podcast from my good buddies Jeff Snyder and Emil Kalinowski. And let me see if I can pull that up on their YouTube channel really quick here. There's the back end of my channel. Let's just go to Making Sense. I know it's come out on their podcast, but I don't know if it's on their YouTube yet. No, it doesn't look. Actually, let's go to Emil's here. I don't think they've got it out, but if you go to their, or yes, here it is. The Treasury bills are trading below reverse repo. So that means that there's a massive demand for pristine collateral. And that would be another thing that would lead me to believe that if the curve inverts, there's an extremely high probability that we would get a recession. So you've got all of these indicators that are screaming recession, but yet you've got the mainstream media, or at least this gentleman with Morgan Stanley, saying that he doesn't see it that way. He sees it the opposite. But my guess is that he doesn't pay attention to some of these, I think, more esoteric, but maybe even more powerful indicators that Snyder and Emil pay attention to, and that being the interest rate on Treasury bills relative to reverse repo. And so why this is important really quick, guys, just to explain it to you, is if you're a money market fund, let's say, you've got the option, or if you're a big, you've got an account with the Fed, or you're a big bank, you've got the option of just parking reserves at the Fed and getting paid. I know it's not 1%, but just let's say that it's 25 basis points right now, just as a hypothetical. So you've got the option of parking your money at the Fed with zero risk, zero, for 25 basis points. But what big pools of money are choosing to do is buy T-bills and get paid, let's say, 20 basis points. Why? Why would anyone in their right mind choose to hold a T-bill at 20 basis points when you could just park your money at the Fed and get 25? The only way that would make sense is if the market sees, number one, an opportunity to make more money or a higher yield on those Treasury bills. But number two, the more that delta increases, the more the dollar funding markets, such as repo, are telling us that they're risk off, that they're making a risk off trade. They see counterparty risk, they see recession risk, whatever it is, they want to hold treasuries even more than just parking their money at the Fed. And so when you have this combined with the fact that the 5-year, 30-year inverted, and that the 2s and 10s are basically like, 5-10 basis points apart, that's another reason why my base case is that we will see a recession if the curve inverts. That's maybe contradicts something that you would probably hear in the mainstream media. All right, guys, enjoy the rest of your afternoon. As always, make sure that you're standing up for freedom, liberty, free market capitalism. We'll see you in the next video.